So we're now ready to do one more example of a short position, and then what we'll do is we'll hop into some other topics. But the thing I said earlier as we went into this, that as you started diving into short positions, you'd feel yourself getting smarter, right? You'd feel yourself, really getting understanding that there's financial education out there that many people don't study and practice and perfect. So let's talk about this one. We had some fun with $100 trillion $100 trillion Zimbabwe bills, right? We had a lot of fun with that, and it was really just an example to reinforce the 4 steps of borrowing, selling, buying, and returning for a basic short position. But it wasn't a real example. I've never made $100 trillion. It was just to show you what could be done. But the one I'm going to show you now is very, very real, and it's something we do a lot of the time. And what this is going to entail is a bank. It's going to entail a bank and probably a real estate broker. Let's put that here: a bank and a real estate broker. So let's do this. Let's put the real estate broker guy over here that we could do. This could be a lot of fun right here. So yeah, let's hop in and get started. So in this one, what we're going to do is we're going to do this. We're going to short the U.S. dollar. Now let's think about that for a minute. Back when we looked at the fundamentals, okay, of investing, let's see if I can bring that back up. Just show you something. We spent a lot of time talking about currency, and one of the things we said is that it used to be, if you recall, we said, look, the valet ticket certifies that you have a car in the garage, and a silver certificate certifies you had silver in the treasury, and a deed certifies that you have the real estate, and the stock certificate certifies you own the business. And you just can't print valet tickets or it's fraud, right? But the more that you print, right, the more you print, the less it gets. So in 1971, we went from backing stuff with gold and silver to what? To just being debt. And we print and we print and we print and we print and we print. And remember what Bernanke said, the former Fed chair. He said, look, like gold, U.S. dollars only have value to the extent they're strictly limited in supply, right? But the U.S. government has a technology that allows us to produce as many dollars as it wants at no cost. So by increasing the number of U.S. dollars, or even threatening to do so, the government can reduce the value of the dollar in terms of goods or services. So we can reduce the value of the dollar, and we've been printing a ton of money. We're printing and printing and printing. I would say that I don't have 100% confidence. That's why we have to have an approximate. But of all, and I don't make stock recommendations. You guys know that. You guys know I don't make currency recommendations, okay? In this case, what I'm saying is that what is the confidence you would have that a gallon of gas is going to cost more in 30 years than it does today? What is your level of confidence that, people always say, boy, back when I was a kid, I could go get a Hershey bar for a nickel or a hamburger for a nickel or whatever. Well, this trend, especially since 1971, has been that the dollar has lost value. And so this is a huge concept about saving or borrowing. Saving or borrowing. We had a wonderful graph that we built here. Let's blow it back up so we can see it. Where we said, hey, if something was going to increase in value, we'd want to accumulate it before we spent it, right? But if something was going to go down in value, we'd want to spend it before we accumulated. Isn't that interesting? We had another, and this is turning things upside down, right? I mean, it really is. We had another great graphic right here that we drew that we said, look, if something's going up in value, we'd want to own it. But if something's going down in value, we'd want to borrow it. Well, when it comes to the US dollar, do you think the value over 30 years that you would want to save $1 over 30 years or borrow $1 over 30 years? If you think, and it's really is up to you, but if you think the dollar over a 30-year time frame, let's just put this 30 years on here. Okay, where do you think the value of $1 is going to go over 30 years? That's the question, up or down. If you believe that the dollar is going to increase in value over 30 years, we'd probably want to save them. If you thought gold was going to get more valuable over 30 years, real estate was going to get more valuable over 30 years, the stock market was going to get more value over 30 years, you'd probably want to accumulate those things. But if you felt the dollar was going to be going down in value, that would be the thing we'd want to borrow. And that is difficult. That is against poor Susie Orman and poor old Dave Ramsey and all these guys. It's hard for them to wrap their heads around this, or maybe they just don't want to. I don't know. Those guys have their place. They're disciplinarians, really. I mean, they're like, hey, get control of your money and control your spending habits and so forth, and get out of debt. Especially Ramsey's like, get out of debt, get out of debt. And that idea of good and bad, assets good, debt's bad, is just so hard to shake. Look, there's nothing wrong with having debt if it's losing value. Nothing wrong with it. If you have debt and it's losing value, you're getting rich. If your debt is losing value, you're getting rich. It's mathematical. It's right there. It's right there. It's the math is inarguable. And so I'm going to show you something that's pretty cool right here. And we're going to finish with this idea that is really interesting. Notice that there's 4 boxes here. 1, 2, 3, 4. And you're going to notice a cash flow pattern for real estate that looks something like this. Watch. You borrow money, you trade it for a house, you get back dollars in rent, and you send it back to the bank. Think about that. You borrow money, you trade the money for a house, you get the money back by getting rent. In other words, you're buying dollars and selling rent, right? You're buying dollars and selling rent, and then return. We've got to get this down to where we understand it. Think about this. Remember, let's draw it again. Okay, we have one person here, another person here, and this guy has bacon, and this guy has eggs. So they make a trade. They make an exchange. Okay, this guy is a seller of bacon. And I won't apologize for doing these over and over and over again, because my experience as a teacher has told me this stuff is hard to understand. So repetition is vital. Seller of bacon and a buyer of eggs. See that? When you take the money out, it becomes more clear. This guy is a seller of eggs. He is a seller of eggs, but he's a buyer of bacon. So let's write that down. See that? Buyer of bacon. Now, we can take this analogy further. Let's just move some of this stuff over so we have some space for a minute. Let's say that we have 2 more people. Okay, let's draw these guys in green to separate them out. And they're going to make an exchange. And this guy has cash, and this guy has a house. Okay, now watch. This guy, they're going to make a trade. This guy is a seller of cash, isn't he? Of currency. And he's a buyer of a house. He's a seller of cash and a buyer of a house. This guy is selling the house. Okay, seller of a house, and he's a buyer of cash. And we're not used to talking that way, but that's really how the exchange works. So it depends on what you're talking about. Did you buy some eggs today? Yes. What did you trade for it? Bacon. Did you buy some bacon today? Yes. What did you trade for it? Eggs. Did you sell your cash today? Yeah. What'd you get for it? I bought a house. Oh, did you sell your house today? Yes, I did. What'd you get for it? Cash. So this guy was a seller of cash. This guy was a buyer of cash. This guy was a seller of a house. This guy was a buyer of a house. When you can understand that, then selling $1 and buying $1 makes sense. So let's say, for example, that this guy was a renter and this guy was a landlord. Same thing. I'm a seller of time in my house, and I'm a buyer of time in the house, but I'm still a seller of cash, and I'm a buyer of cash. Make sense? So I can sell cash, and I can buy cash, right? I can sell cash, and I can buy cash. A seller of cash is a house buyer, right? And a buyer of cash is a landlord, right? True? The landlord is the buyer of cash. So when a person can understand those things, they seem a little complex, you can start to understand this in a really interesting way. Here, we're going to say that we think the dollar is headed down. And we're going to say that our confidence in that idea, our confidence level that the dollar will lose value is high, maybe even approaching 100%. We're going to just say that, okay? So here our investor says, well, when it comes to cash, do I want to be a buyer of it or do I want to be a borrower of it? She says, I want to borrow it. So she says, I want to borrow, and I don't know, let's just say she wants to borrow, I don't know, $100,000 or whatever, right? So she goes to the bank and she says, I'd like to borrow some dollars. I'd like to borrow 100,000 of them, right? So I need an extra dollar here. So let's copy this and come up with an extra buck here. Oh, that's a big dollar there. Look at the size of that sucker. Now that's a big dollar. So let's bring this down. So she says, I'm going to borrow some dollars here. And I'm going to borrow, let's just say 100,000 of them. Okay, whatever. She's going to borrow $100,000, okay? Or 25,000 or whatever. But she's going to buy enough to do a house. So let's say she borrows $100,000 to buy a $100,000 house. Okay, fair enough. So she now owes the bank $100,000. Okay, so we've borrowed it. She owes the bank $100,000. Okay, now the next key is to sell whatever you borrowed. So what could she sell her dollars for? What could she trade her dollars for? She says, I'm going to give them to this guy over here, right? I'm going to give them to this guy over here, and he's going to give me a house. So now we invent an asset called a house. Isn't that crazy? That now you have an asset out of nothing. Please pause and just think about the power of borrowing instead of working for your money. Think about the power of simply borrowing to create an asset out of nothing. Yesterday there was not a house. Today there is. Why would a person work at a job for years and years to try to get money when you can make hundreds of thousands of dollars, even millions someday, by simply borrowing money and acquiring an asset? Just let the simplicity of that idea sink in. The big picture idea. Yeah, I know there's details, I know. But the big picture, we borrowed some money and bought an asset. That's it. We borrowed some money and bought an asset. Now, what is going to happen next? Well, let's put our check mark here because we got this done. So when I say sell, what do I mean? I got rid of my dollar. I'm a seller of dollars, and I'm a buyer of a house, right? Now, watch this. This starts to go down slowly over this 30 years, right? This is going to go down slowly over this 30 years. And what am I going to do? Well, I need to get back some dollars. So I need to be a buyer of dollars, correct? So how to become a buyer of dollars? Sell time in the house. Become a buyer of dollars and sell time in the house. That's called rent. So rent is coming in little by little. I am slowly over time buying back dollars. And then what do I need to do? I owe the bank $100K, right? So over this 30-year term, what am I going to do? I'm going to return these dollars to the bank. Look at this. Borrow. Right there. Borrow. Sell the dollars. Borrow dollars. Trade the dollars for a house. Sell the dollars, right? Buy dollars. I'm buying the dollars and selling rent, right? Return dollars in house payment. All 4 steps are there. Borrow, sell, buy back, and return. Return. All 4 there. There's 4 boxes, all 4. Real estate does not begin with buying a house. Real estate begins with shorting the dollar. Let me say that again. Real estate does not begin with buying the house. Smart real estate usually begins by taking a short position on the dollar. You may have a long position on a house in your own mind, but you have a short position on the dollar if you've used debt at any time. It's an interesting thing. There's a video that my friend Than Merrill in his real estate classes shows, and a lot of people don't even catch what Warren Buffett says is the most important phrase. Listen to the phrase, great way to short the dollar. What we're going to do is we're going to show a video of Warren Buffett talking about real estate, but he's going to say this is a great way to short the dollar. And that's the phrase that just kind of nod your head when you hear him say it. Let's see if I can bring this over. And just to notice again how he's going to talk about shorting the dollar. He's going to talk about debt, mortgages, right? I could take out mortgages. I could borrow money. In effect, it's a way to short the dollar. Watch this. And I think most people don't hear it because they don't know what a short position is. When he says shorting the dollar, it's just kind of blah, 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 because they don't understand what he's saying.
I had a way of buying a couple 100,000 single-family homes and had a way of managing. The management is enormous. It was really a problem because they're one by one. They're not like apartment houses. So, but I would load up on them, and I would take mortgages out at very, very low rates. But if anybody is thinking about buying homes, 5 years ago they couldn't buy them fast enough because they thought they were going to go up, and now they don't buy them because they think they're going to go down, and interest rates are far lower. It's a way, in effect, to short the dollar because you can take a 30-year mortgage, and if it turns out your interest rate's too high next week, you refinance lower, and if it turns out it's too low, the other guy's stuck with it for 30 years. So it's a very attractive asset class now.
So the idea that makes it attractive is he can borrow the money, copious amounts, and over 30 years, in effect, he gets to short the dollar. The dollar loses value. And the beautiful thing is that this is fixed. And so think about it. Over time, the value of the dollar goes down, which means it's easier to pay off this mortgage. Let's say the payment is $1,000 a month or whatever it is. In fact, on a $100,000 loan, maybe it's like $700 a month. And let's say initially the rent is only $800 a month and your cash flow is $100. As the dollar loses value, the price of the house will go up and the rent will go up. So over 30 years, that could be $1,800. Well, it's much easier to pay off a $700 mortgage at an $1,800 income. And now you've got, what is that, you got, $1,100 in cash flow now, right? Now, what if you'd have done this 30 years ago? What if you would have done it as fast as you could 30 years ago? As fast as you can, as much as you can 30 years ago. How many assets would you have? What would the liability be now? And what would the rents be right now? And what would the value of these homes be? So understand that the value of the home doesn't necessarily go up. It will with supply and demand a little bit, but over the 30-year time horizon, the thing that really makes this attractive, that really makes it go up, is not that the house went up, it's that the value of the dollar went down. And it's very, very easy to buy back these dollars when they're cheap because they're not worth much. So if you have a 2,000 square foot home, the square footage doesn't change, but the rent will, right? The asset doesn't change. It's the dollar that has changed. Let me say that again. Still 2,000 square feet. The asset doesn't change. It's the value in the dollar that changes. And if the dollar is low, it's going to take more of those dollars to get a month of rent in this house. It's going to take more of those to get a month of time in this house. 2,000 square foot hasn't changed, but the amount of dollars that it takes to get that house will change. But your payment is the same. And you're giving the bank back dollars that are worth less. Let me say it a little faster. You're giving the bank back dollars that are worth less. Very cool stuff to think about, to play with, to ponder, right? If you would have done this. So I'm a big fan of real estate. Like, I don't really care about the asset class. If you can make it in business, then make it in business. That has the best returns. Hardest one to do, no question. Hard, most competition, very difficult leadership. Read the E-Myth by Michael Gerber. Most people will just because you can make a Subway sandwich doesn't mean you're ready to compete with Subway. There's so many other parts to business. But if you can make it in business, go for it. Because the best ROIs are in business, in my opinion. If you can make it in real estate, go for it. If you can make it in stocks, go for it. If you make it in oil wells, go for it. But whether it's real estate, stock, currencies, or business, whatever it is, understanding a long position and also understanding a basic short position allows people to position themselves in the world to make a lot of money. Real estate investors, many people have been investing in real estate for a long, long time and still don't understand that what they're effectively doing is shorten the dollar. Effectively, that's what it is.
I would load up on them, and I would take mortgages out at very, very low rates. But if anybody is thinking about buying homes, 5 years ago they couldn't buy them fast enough because they thought they were going to go up, and now they don't buy them because they think they're going to go down, and interest rates are far lower. It's a way, in effect, to short the dollar because you
see. Effectively, that's really what it is you're borrowing a dollar and you're borrowing something that's going to go down most likely over time. So I hope you enjoyed this section on shorts with example after example after example after example. And we're ready to move on now to other forms of leverage in the 4 pillars of investing. There's one more thing I'll say that I'd be remiss if I didn't say. I'm glad I remembered this because, boy, I would have been remiss to leave it out. When you're shorting stocks, so let's get these dollars out. There's one more risk that I want to talk about called dividend risk. The person who owns the stock at the brokerage that you've borrowed it from, he still owns it. He's just loaned it out to you. So there's something called dividend risk. And I'm glad I remembered this because I'd be remiss if I didn't. That if you decide you want to short the stock and you borrow the stock, you may have possession of it and you might want to sell it and short it and do whatever you want once you borrow that stock, but he's entitled to his dividend because he owns the stock. Just like if you rent a house, you're entitled to the tax benefits because you own the house, right? The renter doesn't get the tax benefits, you do. Well, this guy that owns the shares, so if you borrow the shares, you're going to have to pay him that dividend. You owe him that dividend. And that's fine. It's not a big deal. It's just called dividend risk. But he's going to get his dividend. And so if you get a dividend while you have possession of it, you got to pass it along to him. There's dividend risk. You pay the dividend on that. So it's important to know. But other than that, that's shorting. That is a short position. So very, very cool. So it's been a really, really good foundation, in cash flow. Now it's time to start practicing, okay? So let's take a look at some action steps. Go back into theater mode here. Paper trade 5 long positions and paper trade 5 short positions. Now, there's going to be order entry and there's going to be stuff, got to know how to enter an order and all that. make sure, if you have not already, review the Investor Bootcamp, the Beginning Investor Bootcamp, that gives you explanations of order entry, basically what buttons to push to get in and out. And just pick 5. Now, you have a chance to put it all together. You could do, you've already gone and practiced running a fundamental analysis, right? You know how to search for criteria on fundamental analysis, right? You've practiced technical analysis. You know how to search for criteria on technical analysis. So maybe you run a search and find a list of fundamental stocks, and then you check their charts and you find one with an ascending triangle. Well, if it's an ascending triangle, try a long position. If it's a descending triangle, try a short position. And be aware of the broad market. If the broad market is trending up, see if the longs work out better than the shorts. If the market is trending down, see if the shorts work out better than the longs. Now, we're not trying to make money in this exercise. We're not even trying to care about a result. And I know that's hard to have the discipline to do. I know. We want to make money. We're excited to go make money. Right now, we're just practicing on paper to see what happens, right? Almost with a curious nature to observe rather than to plan an outcome. Okay, we're not worried about whether we make money or lose money on these first few trades. We're just going to observe and say, okay, I'm going to practice my fundamentals that I learned. And it's important at this point not to be lazy, to really understand this is what it looks like to trade. So go do a fundamental analysis, run some searches like you've already practiced and done, look at the charts, make some technical analysis. You're not going to be perfect. It's okay. We just want to get on 5 longs and 5 shorts and watch them for a little while. It might be a week, might be 2 weeks. And just watch and see what happens with the market and which ones triggered exits, which ones triggered targets. And we'll learn how to move our stop. And there's a lot we're going to do beyond this. So don't for one moment think this is the end all be all, that, oh, great, I'm ready to trade now. Not even close. We haven't talked about exits and adjustments and hedges, and we haven't even done the 4th pillar yet. And so there's tons of adjustments we can make. Right now, all we're doing is throwing on. Now, if you're lazy and you don't do your fundamentals and technicals, great. Pick 5 longs, pick 5 stocks out of a hat and long them, and pick 5 stocks out and short them. But I'll tell you, best way is to keep practicing the first 2 pillars and now add this 3rd pillar to try to get some cash flow. Very much practice plotting those points that we learned. Your entry point, right? Your target and your exit for your long, and then your entry point, your target is down and your exit is up for your short. Okay, so start practicing those. Get your risk reward and see what the risk reward are. We'd like to have at least $2 of risk every dollar of reward when we trade stocks. And then finally, just see the value of hanging out with your Cash Flow Academy coaches in your little group coaching sessions. That's going to be a huge help to you. So if you haven't taken advantage of that yet, go to the website and figure out how to enroll and go out and rock and roll. It's going to be a lot of fun. Great job.